In 2019, a woman named Elena maxed out her Roth IRA for the first time. She was 26, made $52,000 a year, and felt like she'd finally done the responsible adult thing. 7 years later, at 33, she got a raise into a job paying $190,000 a year, and she kept doing the exact same thing, maxing out that same Roth IRA, because that's what she'd always done. Here's what nobody told Elena. The math that made the Roth a great decision at 26 was quietly working against her by the time she was 33. Same account, same habit, completely different outcome, and she had no idea because nobody ever told her the Roth IRA isn't a rule, it's a bet. And the odds on that bet change as your life changes. I'm going to show you exactly how that bet works, why almost everyone gets the odds wrong, and where the real money is actually hiding in this decision, the stuff Roth IRA content never covers. Stick around because by the end you'll know whether you should still be making Elena's bet or whether it stopped paying off years ago. My name is Uncle Investor, and I break down retirement accounts the way I wish someone had broken them down for me. If you want a clear, no-hype look at where your money should actually go, subscribe and hit the like button. Before we get back to Elena, let's deal with an uncomfortable fact. The Roth IRA is not popular because it's mathematically superior for most people. It's popular because it is, structurally, the easiest financial product on earth to sell you. A 401k is chosen for you. Your employer picks the custodian, negotiates the fund lineup, hands you a menu. There's no affiliate commission sitting behind, here's the 401k your HR department already selected for you. A Roth IRA, on the other hand, you can open in 15 minutes at any brokerage and every single company offering one wants to be the one you pick. That mismatch, one account category you shop for and one you don't, quietly built an entire content economy pointed at convincing you to act today on a decision that is genuinely uncertain for a huge number of people. Look at the actual behavior. According to the Investment Company Institute's 2024 IRA database, about 44% of U.S. households own an IRA of any type. Fidelity's Q4 2023 retirement account analysis shows the typical IRA contributor puts in far less than the max, with the median annual contribution under $1,200 against a 2026 limit of $7,500 or $8,600 if you're 50 or older. Most people who have a Roth IRA are not treating it like the emergency it's marketed as. So why the mismatch between the hype and the behavior? 3 structural reasons, and I'll go through them fast because you already sense them intuitively. IRAs are shoppable, so they're monetizable. Tax-free money in retirement is a better headline than tax-deferred growth in your 401k, even though they're the same idea told 2 different ways. And the rule book around Roth IRAs, income limits, the backdoor strategy, the 5-year rule, conversion ordering is genuinely confusing, which means there's an infinite supply of content to make about it. None of that says anything about whether it's the right account for you. It says something about why you keep hearing about it. Here's a statistic that will change how you see this account category permanently. According to the Investment Company Institute's analysis of IRA rollover activity, combined with Federal Reserve Board survey of consumer finances data analyzed by the Employee Benefit Research Institute, rollovers from employer-sponsored retirement plans accounted for 94% of all traditional IRA contributions in recent years, while new cash contributions made up just 6%. Separate ICI flow data shows that in a typical year, rollover contributions to traditional IRAs run somewhere between 10 and 20 times larger than new direct contributions. Let me translate that. Picture $100 sitting in the average traditional IRA. Something like 90 to 95 of those dollars rolled in from an old 401k after someone changed jobs. Maybe $5 to $10 came from someone actually writing a check into the account year after year. That reframes the whole category. In practice, the IRA is primarily a parking structure for wealth the 401k already built, not the vehicle that builds the wealth in the first place. Keep that in the back of your mind because it matters for the framework I'm about to give you. Here's the part that changes everything. and it's the reason Elena's Roth habit quietly stopped making sense. A traditional account and a Roth account are the same investment taxed at two different points in time. Traditional, you get a deduction today. You pay ordinary income tax on withdrawals later. Roth, no deduction today, tax-free growth and tax-free withdrawals later. The entire decision reduces to one number. Is your tax rate today higher, lower, or about equal to your expected tax rate when you'll actually spend this money? That's the whole bet. I'm calling it the tax bracket bet, and here's the actual scorecard I use to evaluate it. 4 questions. Answer them honestly for your own situation. Question 1. What's your marginal tax bracket right now this year? Specifically, not am I doing okay, the actual bracket. If you're in the 12 or 22% bracket, you're in cheap tax territory. The Roth bet favors you strongly because you're locking in a low rate today. Question 2. What's your realistic bracket in retirement, accounting for Social Security, pensions, and any RMDs you'll eventually be forced to take? Most people underestimate this because they picture retirement as a low-income period. For some it is. For high savers with large 401k balances, forced withdrawals later can push them into brackets similar to or higher than their working years. If your future bracket looks similar to today's, the traditional deduction is worth more because a guaranteed deduction today beats an uncertain tax-free benefit decades out. Question 3. Do you expect your state of residence to change? If you're contributing in a high state income tax state today, but plan to retire somewhere with no state income tax like Florida or Texas, that traditional deduction you take today is worth more than the state tax you'd eventually avoid paying on Roth withdrawals in a no-tax state. This single variable can outweigh the entire federal bracket conversation, and it's one almost nobody models. Question 4. Do you need this money to be flexible before age 59 and a half, or are you building strictly for retirement and beyond? This determines whether you're even playing the retirement account game at all, or whether a taxable account fits your timeline better. We'll come back to this. Run your own numbers through those 4 questions, and you'll know which side of the bet you're actually on instead of following a slogan. Here's Elena's answer, by the way. At 26, in the 12% bracket, with decades of runway and no idea what state she'd retire in, the Roth was the correct side of the bet. At 33, in a 32% bracket, that same bet flipped. She was now paying full price in taxes today for a benefit that, given her income trajectory, she may not even need at that rate later. Same account, same habit, completely different bet. Stop here for 10 seconds and ask yourself, which bracket are you in right now, and where do you honestly think you'll be in retirement? If those two numbers are within 5 percentage points of each other, you're in the danger zone where most people default to the Roth without realizing the traditional might actually be saving them money. Write your answer down. We're coming back to it at the end. Here's a mechanism that almost no Roth hype content ever explains with actual numbers. Required minimum distributions, or RMDs. Under the Secure 2.0 Act, once you turn 73, the IRS forces you to start withdrawing from traditional IRAs and traditional 401ks, whether you need the money or not. That age used to be 70 and a half, then moved to 72, now it's 73, and it rises to 75 in 2033. Miss your RMD, and the penalty under current law is 25% of the amount you should have withdrawn, dropping to 10% if you correct it within 2 years, per IRS excise tax rules under IRC Section 4974. That forced withdrawal counts as ordinary taxable income, and it can shove you into a higher bracket in a year you weren't planning for one, right, when you're also trying to keep Medicare premiums under control. Which brings me to the part of this that genuinely surprises people. Medicare's income-related monthly adjustment amount, called IRMAA, kicks in based on your modified adjusted gross income from 2 years prior. Let me repeat that because it's the piece almost nobody explains clearly. If you have a large RMD in 2026, your Medicare Part B and Part D premiums don't increase in 2026, they increase in 2028 based on your 2026 income. That 2-year lag makes planning harder because the consequence of a withdrawal decision shows up long after you made it. In 2026, IRMAA surcharges begin once your income crosses $106,000 as an individual or $212,000 for a married couple filing jointly, and these thresholds are indexed annually. Cross that line by $1, and your Medicare Part B premium doesn't inch up. It jumps in a step function. From the standard $185 a month to $259 a month at the first IRMAA tier. That's an extra $888 a year in Medicare cost triggered by a single dollar of income over the threshold. And it gets steeper. The top IRMAA tier for individuals with MAGI above $500,000 or couples above $750,000 pushes Part B premiums to $628.90 a month, plus additional Part D surcharges. A poorly timed RMD can push you across one of those exact cliffs. And because of the 2-year look back, you won't know you crossed it until the bill shows up 24 months later. Roth IRAs don't have this problem. Under current law, there is no lifetime RMD on a Roth IRA you own yourself. Roth 401ks used to have RMDs, but Secure 2.0 eliminated that requirement starting in 2024. That's not a minor footnote. That's a genuine structural advantage, not because tax-free growth is magic, but because it hands you control. You decide when to take the money instead of the IRS and Medicare deciding for you 2 years later. Here's a node that gets almost no coverage anywhere, and it has nothing to do with your own retirement. A Roth IRA can be one of the most efficient things you ever leave behind. Under the Secure Act rules that took effect in 2020, if you pass a traditional IRA to anyone other than a spouse, most beneficiaries are now classified as non-eligible designated beneficiaries, and current law generally requires them to empty that inherited account within 10 years of your death. Every dollar they withdraw during that 10-year window is taxed as their ordinary income, often during their own peak earning years. Here's what that looks like in real numbers. Imagine you leave a $200,000 traditional IRA to your daughter. She's 42, working, earning $120,000 a year, solidly in the 24% federal bracket. Under the 10-year rule, if she spreads those withdrawals evenly, she's pulling out $20,000 a year, and every dollar of that is stacking on top of her existing income. Depending on how much of that $20,000 pushes her into the next bracket, she could easily pay a blended effective rate around 28 to 32% on the inherited distributions once you account for the marginal rate on the top portion and potential state tax. Run the math. $200,000 times a 30% blended tax rate is $60,000 handed to the government, not to her. She inherits $140,000 after tax out of the $200,000 you left. Now run the same scenario with a Roth IRA. She inherits $200,000. The 10-year withdrawal rule still applies, but every dollar she takes out is completely tax-free. She nets the full $200,000. The difference, $60,000, is the tax you already paid decades earlier when your income was lower and your bracket was cheaper. If leaving money behind matters to you, that math turns the Roth IRA into something closer to an estate planning tool than a retirement account, and that's a completely different reason to hold one than tax-free growth, one that applies even if you personally never need to touch the money. Let's talk about why this decision feels so emotionally loaded, because it explains a lot of the Roth IRA's cultural grip. In their 1979 paper, Prospect Theory, an Analysis of Decision Under Risk, published in Econometrica, psychologists Daniel Kahneman and Amos Tversky documented something they called the certainty effect. People consistently overweight outcomes that are guaranteed compared to outcomes that are merely probable, even when the probable outcome has better expected value. In their experiments, subjects reliably chose a guaranteed smaller gain over a larger but uncertain gain, even when the expected value of the uncertain option was mathematically higher. That shows up everywhere in financial behavior, but it's especially visible in the Roth versus traditional choice. Pay the tax now, guaranteed, done forever. Feels safer than defer it and hope the math works out, even in situations where deferring is objectively the better bet on paper. The Roth gives you certainty. You know exactly what you paid. You know there's no future tax bill. That psychological comfort is real, and for some people it's worth paying for, even if it costs them money in expected value terms. That's not a criticism of anyone who prefers the Roth. It just means part of its appeal isn't math. It's the psychological comfort of closing an open loop. Once you can name that feeling for what it is, you can decide whether you're choosing based on the numbers or based on how the choice makes you feel. And those are two very different reasons to make the same decision. Both are valid, but only one of them is about maximizing wealth. Two pieces of Roth mechanics get mentioned constantly and explained rarely. Let's fix that. If your income is too high to contribute to a Roth IRA directly, in 2026, that phase-out starts at $153,000 for single filers and $242,000 for married couples filing jointly, and completes at $168,000 and $252,000 respectively. You can still get money into a Roth using something called the Backdoor Roth. You contribute to a traditional IRA, which has no income limit for contributions, only for deductibility, and then convert that contribution to a Roth IRA shortly after. You pay tax on any investment growth that happened between contribution and conversion, but if you convert quickly, that's often close to nothing. This strategy was formally acknowledged by the IRS in the 2018 revision of Publication 590-A, and it survived explicit congressional review during the drafting of the Build Back Better Act in 2021, which proposed banning it, but ultimately did not. As of 2026, it remains a completely legal, IRS-recognized strategy. Not a loophole in the shady sense, it's just underexplained. One critical trap. If you have any pre-tax money sitting in a traditional IRA anywhere from old deductible contributions or previous rollovers, the IRS applies something called the pro-rata rule under IRC Section 408D2. You can't just convert the new non-deductible contribution and ignore the rest. The IRS treats all your traditional IRAs as one big pool, and every conversion pulls from that pool proportionally. If you have $95,000 of pre-tax money in a rollover IRA and you try to backdoor convert a $6,500 non-deductible contribution, you don't get to convert just the $6,500 tax-free. You're converting a proportional mix, and you'll owe tax on most of it. That wrecks the whole strategy. The workaround, if your workplace plan allows it, is to reverse roll your existing traditional IRA money into your 401k before doing the Backdoor Roth, which clears the pro-rata trap. Now, the 5-year rule, which is actually two separate rules, and conflating them is where most confusion comes from. Rule 1, for tax-free withdrawal of earnings from a Roth IRA, the account must have been open at least 5 years, and you generally need to be 59 and a half or meet another qualifying condition, death, disability, or first-time home purchase up to $10,000. This clock starts January 1st of the year you made your first Roth contribution to any Roth IRA ever. If you opened your first Roth IRA in December 2022, your 5-year clock started January 1st, 2022, and it satisfies in January 2027. Rule 2, each Roth conversion you do has its own separate 5-year clock before you can withdraw that specific converted amount penalty-free if you're under 59 and a half. This is to prevent people from using the conversion as a backdoor early withdrawal strategy. If you convert $10,000 in 2024, that $10,000 has to sit until 2029 before you can pull it out penalty-free if you're under 59 and a half. If you do another conversion in 2025, that's a separate clock starting in 2025. If you're doing multiple backdoor Roth conversions across several years, you are tracking multiple 5-year clocks running simultaneously, not one. Contributions to a Roth IRA, the money you put in directly, not conversions, can be withdrawn anytime, tax-free and penalty-free, because you already paid tax on them. The IRS ordering rules say your withdrawals come out in this sequence: contributions first, then conversions in chronological order, then earnings last. That means if you've contributed $30,000 over the years and your account is worth $50,000, you can pull out up to $30,000 anytime with zero tax and zero penalty, regardless of your age or how long the account has been open. Most Roth IRA content collapses all of this into tax-free withdrawals, which is true eventually, but the path to getting there is more complicated than the marketing suggests. I want to Steelman this account because it earns its reputation in real situations. If your early career in a genuinely low bracket, question 1 from our framework already answers itself in the Roth's favor. A 2021 Vanguard research paper, The Roth versus Traditional IRA Advantage, an expected tax rate sensitivity analysis, modeled thousands of scenarios and found that for investors in the 12% bracket expecting even modest income growth over a career, the Roth produced better after-tax outcomes in more than 70% of simulated retirement scenarios. That advantage shrinks dramatically as your current bracket rises, but at 12%, the math is legitimately on the Roth side most of the time. If your workplace plan is mediocre, thin fund lineup, high expense ratios, and IRA at a low-cost brokerage is a real upgrade, and doing it as a Roth lets that upgrade compound completely tax-free. Morningstar's 2023 analysis of 401k fee structures found that plans with under 100 participants often carry expense ratios 50 to 100 basis points higher than large institutional plans. If your 401k is charging you 1.2% in annual fees and a Vanguard IRA would cost you 0.04%, that 116 basis point gap, compounded over decades, is worth more than almost any tax consideration. If you're approaching retirement, having a mix of taxable, pre-tax, and Roth money gives you the ability to control your bracket year by year, manage that IRMAA cliff we just talked about, and control how much of your Social Security benefit gets taxed. Up to 85% of your Social Security benefit can become taxable depending on your other income. If you can fill your lower brackets with traditional IRA withdrawals and Social Security and then pull additional spending money from a Roth without increasing your taxable income, you effectively create tax-free room above your standard deduction that would otherwise be taxed. That flexibility carries real dollar value across a multi-decade retirement. There's also a behavioral upside that's hard to quantify but impossible to ignore. Researchers Richard Thaler and Hersh Shefrin, in their 1981 paper, An Economic Theory of Self-Control, published in the Journal of Political Economy, documented the phenomenon of mental accounting. People treat money differently depending on how it's labeled, even though dollars are fungible. A dedicated account labeled, "This is for retirement, don't touch it," changes how people actually treat that money. It creates what Thaler calls a commitment device, a self-imposed restriction that makes it psychologically harder to raid the account for non-retirement spending. The Roth IRA's tax penalty on early withdrawal of earnings functions as exactly that kind of device, and for people who struggle with spending discipline, that structure has value independent of the tax math. Now here's where I push back hard on the conventional wisdom, and this is the part almost no one selling you a Roth IRA wants to bring up. Money inside a retirement account is locked up by design. Yes, your Roth contributions specifically have workarounds, and yes, there are early withdrawal exceptions, but structurally, this account exists for money you won't touch for decades. If you're saving for a house, a business, early retirement before 59 and a half, or just a bigger cushion, a taxable brokerage account often serves you better, and it's far more tax efficient than its reputation suggests. Let me show you the actual math, because this is where almost every Roth comparison gets it wrong. They compare a Roth IRA to a taxable account and assume the taxable account is getting destroyed by taxes every year. It's not. Here's a realistic scenario. You invest $7,000 a year into a low-cost total market index fund, something like Vanguard's Total Stock Market Index Fund, VTSAX, with an expense ratio of 0.04% and a current dividend yield around 1.3%. You hold it in a taxable brokerage account. You don't trade. You don't rebalance constantly. You just let it sit and reinvest the dividends. We'll assume 8% average annual growth, which is conservative relative to historical equity returns, and we'll assume qualified dividend treatment taxed at 15% for someone in the 22 or 24% ordinary income bracket. Year one, you invest $7,000. It grows 8%, so you end the year with about $7,560. The fund pays a 1.3% dividend, about $91. That's a qualified dividend taxed at 15%. So you owe about $14 in tax, not 14%. $14. Year 10. You've contributed $70,000 over the years. Your balance is now around $109,000 thanks to growth in reinvested dividends. The dividends that year are about $1,400. Taxed at 15%, you owe about $210 in taxes. Your tax drag as a percentage of your portfolio value is 0.19%. Less than 0.2%. Year 30, you've contributed $210,000. Your balance is now roughly $930,000. The annual dividend is around $12,000. Taxed at 15%, that's about $1,800 in tax. Your tax drag as a percentage of the portfolio is 0.19%. It stays nearly constant because the dividend yield stays relatively stable and you're not realizing capital gains. Now here's the part that matters. When you finally sell, you pay long-term capital gains tax on the growth, but only on the growth and only when you sell. If you contributed $210,000 and it grew to $930,000, your capital gain is $720,000. At a 15% long-term cap gains rate, that's $108,000 in tax eventually when you sell. But that's 30 years of tax deferral on the growth, and you had access to every dollar along the way. No RMD, no age restriction, no penalty. Compare that to the Roth IRA, where you pay tax on the $7,000 upfront every year at your ordinary income rate. If you're in the 24% bracket, you're paying $1,680 a year in tax just to get the money into the Roth. Over 30 years, that's $50,400 in taxes paid up front. The taxable account, by contrast, paid about $1,800 a year in dividend tax, $54,000 over 30 years, almost the exact same amount. And you still have the entire balance accessible with no age restriction. The Roth wins if your tax rate in retirement is higher than 24%. The taxable account wins if you need any of that money before 59.5, or if your retirement bracket ends up lower. And if you hold until death, the taxable account gets a step up in basis under current law, IRC, Section 1014, meaning your heirs inherit it at the current market value and owe zero capital gains tax on the appreciation that happened during your lifetime. The Roth gives them tax-free income, but the taxable account gives them a tax-free step-up. Both are tax-advantaged at death, just in different ways. I'm not saying the taxable account is always better. I'm saying it's far closer than anyone holding a Roth IRA wants to admit, and it comes with something the Roth doesn't: complete liquidity. So where does the IRA belong in your real financial life? I'm going to give you a decision tree, not a linear list, because your situation determines your path. Stage 1, the foundation. This applies to everyone. Capture your full employer 401k match first. This is the only true free money in investing, an immediate 50 to 100% return before you've invested a single dollar anywhere else. Then eliminate any debt with an interest rate above 6%. Credit cards, most personal loans, because paying off a 19% APR credit card is a guaranteed 19% return, and no investment consistently beats that. Then build an emergency fund covering 3 to 6 months of expenses in a high-yield savings account because liquidity prevents you from having to raid retirement accounts early and trigger penalties. Stage 2, the competition for your next dollar. This is where the decision tree splits. If you have access to a health savings account and you have a qualifying high-deductible health plan, the HSA often comes first, even ahead of the IRA. This account is triple tax advantaged, contributions are deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free, and after age 65, it functions like a traditional IRA for non-medical withdrawals. There is no other account in the tax code with that structure. Max it if you can. The 2026 limit is $4,300 for individuals, $8,550 for families. Then run your tax bracket bet from earlier. Based on the answer, fund either a Roth IRA or a traditional IRA, whichever side of the bet your 4-question scorecard points you toward. If you're in the 12% bracket, Roth. If you're in the 32% bracket and expect lower taxes later, traditional. If you're in the 24% bracket and genuinely uncertain, split the difference, put half in each, or tilt toward whichever gives you more flexibility for your specific situation. Then, if your workplace 401k plan is genuinely excellent, low-cost index funds, institutional share classes, good match. Push additional dollars back into the 401k beyond the match. The 2026 employee contribution limit is $23,500 or $31,000 if you're 50 or older. If your plan offers both traditional and Roth 401k options, apply the same tax bracket bet logic. If your workplace plan is mediocre or bad, stop at the match and route additional savings into the IRA or a taxable account instead. Stage 3. Once stages 1 and 2 are fully funded. Taxable brokerage investing for long-term wealth. Building with full liquidity. Extra mortgage paydown if your rate is above 6% and you value the psychological win of owning your home outright. Or 529 plans if you're saving for a child's education and your state offers a tax deduction for contributions. Notice what this is not. It's not everyone should max their Roth IRA. It's not the IRA is always step 2. It's a map that changes based on where you actually are. Let me give you a real counterexample because this is how you know whether a framework actually works. Meet Jason. He's 29, earns $215,000 a year as a software engineer, lives in California, pays a 9.3% state income tax, and he's been doing the Backdoor Roth IRA every year since he got his first job out of college. He maxes it, converts it, pays the tax, and feels like he's doing everything right. Here's what Jason didn't model. He plans to retire at 55 using a combination of taxable account savings and Roth conversions. He wants to move to Nevada or Texas when he retires, both zero state income tax. His current federal marginal bracket is 35%. His current California state bracket is 9.3%. His combined marginal rate today is over 44%. When he retires at 55 in Nevada, he'll have no W-2 income. He can fill up the 0% bracket, 10% bracket, and 12% bracket entirely with Roth conversions and taxable account withdrawals that are mostly tax-free thanks to basis and long-term cap gains treatment. His effective tax rate in early retirement will be under 10%, and his state tax rate will be 0. Jason is paying 44% tax today to avoid paying 10% tax later. That's not a good trade. A traditional 401k contribution today saves him 44 cents on the dollar. He can convert that money to Roth later in Nevada at 10 to 12% and pocket the 32-cent difference. The backdoor Roth in his situation is costing him a third of his money. I'm showing you Jason because he's the exact profile most Roth IRA content is aimed at. High earner, disciplined saver, doing the advanced strategy. And the advanced strategy is wrong for him. The tax bracket bet is screaming traditional, and he's ignoring it because the content he's consuming never asked him to run the 4 questions. So what should Elena have done at 33? Run the 4 questions, her current bracket, 32% federal, her future bracket, she had a growing 401k, a paid-off home, and a pension from a previous employer. RMDs in her 70s were likely to push her into the 22 or 24% bracket even without additional work income, maybe lower if she planned Roth conversions strategically in her early 60s. Her state, she lived in Illinois, 4.95% flat tax, and she was considering a move to Florida at retirement, 0 state tax. Her liquidity needs, none. She had a taxable account and an emergency fund. Every single one of those signals pointed toward the traditional side of the bet, not the Roth side she'd been running on autopilot since she was 26. Here's what she actually did when I walked her through this. She stopped contributing to the Roth IRA entirely. She redirected that money into her 401k as traditional contributions, which saved her 32% federal plus 4.95% state, a combined 37% on every dollar. Then, when she retires early in Florida, she'll convert chunks of that traditional 401k money to Roth in the low brackets, 10, 12, maybe some at 22, paying zero state tax because Florida has none. She'll pay 10 to 22% on the conversions instead of the 37% she would have paid up front. The difference, 15 to 27 cents on every dollar, goes into her pocket. That's not a theoretical win. That's real money she gets to keep because she stopped following the account with the best marketing and started following the math. Now it's your turn. Pull up your last pay stub or tax return. Answer the 4 questions from earlier. Write down your current marginal bracket, federal and state. Write down your best guess at your retirement bracket. And be honest, if you're a high saver with a growing 401k, your retirement bracket may not be as low as you think. Write down whether your state is likely to change. Write down whether you need liquidity before 59 and a half. If your current bracket is more than 5 percentage points higher than your expected future bracket, the traditional bet is probably right. If your current bracket is lower or within 5 points, the Roth bet is probably right. If you genuinely can't tell, split it or tilt toward the one that gives you more control. And for most people, that's the Roth, because RMD flexibility and estate planning value are real. The tax bracket bet only pays off if you actually check the odds instead of following the account with the best marketing. If this changed how you think about your own contributions, that's exactly what I wanted. Tell me in the comments, when you run the 4 questions on your own situation, which side of the bet do you land on? And did the answer surprise you? I genuinely want to see the range of answers because I know a bunch of you are going to realize you've been on the wrong side of this bet for years. If you got something out of this, hit like. If you're new here, subscribe. I put out a video like this every week, breaking down retirement accounts, tax strategy, and investing with no hype and no affiliate agenda. If this helped you, share it with the person in your life who's currently being told to just open a Roth IRA with no explanation of why. And if you're wondering what to actually do once you're retired and pulling money out of these accounts, in what order and how to minimize the tax bill across a 30-year retirement, I already covered that in a previous video. It's called The Retirement Withdrawal Strategy Nobody Tells You About, and it's the natural next step after this one. I'll link it at the end of this video and in the description. Thanks for watching. I'll see you in the next one.